Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday to you. Every single week, we want to give you sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. Our number, 833-964-PLAN, 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. I said it before, but I'm going to say it again. You know, as we came into the year, I think the best expression that people can have when it comes to their investments is pragmatic optimism. Yes, you need to have pragmatic optimism coming into this year, because if there's a reminder, there's been way too much doom and gloom that's out there. You look at how consumer sentiment is, you look at how people feel about various things, there's an awful lot of doom and gloom. But if we follow the data and we make data-driven decisions, I think you got to be super excited about the setup that you have for 2025. Now, that doesn't mean that it's going to be an S&P 500 that roars ahead to double-digit rates of return, but it does mean those who are properly allocating capital can definitively benefit. And again, where that benefit comes from is we think stocks are going to follow earnings per share growth. Yes, stocks do follow earnings per share growth. And with stocks following EPS, if you have strong single-digit earnings per share growth, I think you can see that same amount expressed through the equities in your portfolio, which will once again keep you ahead of inflation. But what's going to be difficult? It's going to be really hard to get the multiple expansion we've had in previous years. I mean, think about last year again in the stock market. You know, you had 9% operating earnings, 13% multiple expansion, put a dividend on top. That's a great total return. The dividends are still here. The earnings per share should come in, but that multiple expansion is in the PE is going to be really tough to get. It's going to be tough to get because stocks, just like trees, they don't grow to the sky. There's a limit on reasonable valuations, and that's what you got to be paying attention to. You know, what else gets me excited? The U.S. unemployment rate gets me excited. It should get you excited too. I mean, we've had not one, not two, but 49 months in a row of job growth. 49 months in a row of job growth. That's the second longest streak in history. And consumers are still deleveraging. Don't get me wrong, the absolute level of credit card debt is high. But the truth is, if you look at people's wages relative to their balances, they're really doing okay. And you want to know what's exceptional? The U.S. is exceptional. What makes the U.S. exceptional? We, the American consumer, make us exceptional. Who invented the credit card? America. Who invented the shopping mall? America. Who invented, again, online business to consumer? Think Amazon, etc. America. I mean, heck, we even invented the value meal. I mean, it's too difficult to put together a burger, fries, and a drink. Now you just point to a picture and say, I'll have a number two. And if you think about traveling the world, you know, if you've been fortunate, you've gone overseas, you know, who owns the river cruise market? Americans. Who's traveling all through Europe? Americans. And why do I point this out? Because while people say they feel so bad and they're so negative about things, there's plenty of proof that people are out there spending. And if you paid attention to those clues, you paid attention to this U.S. exceptionalism I mentioned of the U.S. consumer, then it kept you invested in 2023 when times looked tough. It made you invested in 2024, and it had you invested January through the first part of February 2025. Now, are there some cracks that are out there? Of course there are. But I think some of those cracks are overshadowed still by the fact that we have a potential game changer. That game changer is productivity. If you're just joining us, I'm talking to you right now about why you should have pragmatic optimism for your investments if you allocate right in 2025. And productivity is a big part of that. And productivity, high productivity, that boosts wages while hopefully keeps a lid on inflation, allows the Federal Reserve to ease up a bit. And if you can get to a point where the Fed can restore some additional rate cuts, which won't be anytime soon, wouldn't be until the fall of 2025, maybe September at the earliest, that is a very good backdrop for investing. I just want you to be thinking about that. So what's on your to-do list? Well, let's talk about that to-do list. The first is equities continue to run. Now, again, I say stocks aren't going to run at this breakneck pace that they once had, but there are places to be overweight and places to be underweight. And I still say, being overweight US, being overweight growth just makes a lot of sense in today's economic environment. I can't get as excited about emerging markets. I can't get as excited about Europe. Why? The tariffs are real. The tariffs are here. So I think you got to stay a US-centric portfolio. That doesn't mean you shouldn't be diversified. But in addition, when you're looking at that US-centric portfolio, it's about market caps. And I do think that this is the year that you consider rotating some dollars from what's been S&P 500 into S&P 400, S&P 600 to get multiple market cap exposure in your portfolio. Because one, diversification is the only free lunch when it comes to investing. And number two, you want to move to where there is relative value. And I think the PEs, the price relative to the earnings in those small mid caps, is screaming, hey, buy me. You need to make sure there's some dollars there. In addition to that, you got to think about the style. And when I say the style, we talked before on this show time and time again that as goes January, oftentimes so goes the year. And look at where the leadership was in January. Financials, healthcare, industrials, okay? Those were some of the leading places, not just technology and communication stocks, and we should take our cues from that. Now, U.S. exceptionalism. I'm going to talk later again about alternative investments in the show. But U.S. exceptionalism also is the artificial intelligence boom. And the artificial intelligence boom is ultimately powered by data centers. And who's got more data centers than the next 10 countries combined? We do. I am prideful of that. I think it is fantastic. I think it is awesome that we have more data centers because generative AI, these large language models, it takes a tremendous data center with tremendous power consumptions to move this ahead. And I think that makes data centers the new gold. And isn't it nice that we have an inside lane compared to the competition, which is everywhere across our borders? Outside of our borders, rather. And I think you have an administration that recognizes the importance of data centers, the onshoring of data centers, and you have an administration that recognizes the power consumption that's going to be needed. And that's an investable theme. We'll talk about that later in today's show as well. So when you're investing, while you hear the upbeat optimism that's in my voice, be prepared that this third year of the bull market, if history's our guide and it's the only guide we have, it's typically a volatile one. And I think that's already showing up this week. You saw that in the back half of the week, the way the market's traded with returned VIX, returned volatility on Thursday and Friday. Just know that that's normal, but know that it can be taken advantage of as you rebalance in, around it, and through it. But what's really important is if you want to get retired and stay retired, you have to make sure you understand what your risk budget is. Now, risk tolerance, that's an emotional condition. Risk tolerance is about sentiment. Risk tolerance is about measuring how you feel about things. Your risk budget, though, that's a statistical measure relying upon probability analysis to calculate our capacity, meaning our ability to engage with risk. And that's where we've got to spend some time, because what too many people are doing is they understand and they make investments based on risk tolerance, how they feel, that emotional condition. And don't get me wrong, that's important. You have to be able to sleep at night. But what you really need to make sure you understand is your risk budget, because a lot of people have gotten to a place that they can get retired. I'm concerned that everyone stays retired. And that means having a properly documented set of governance for the investment management of your portfolio so that you don't exceed your risk budget. So, regardless of what the world throws at us, you get to stay retired. And I invite you to learn more about how we do that, how we have culminated and brought together a multidiscipline professional group in the areas of investment advice under that fiduciary standard, your cash flow and goals-based modeling under the CFP standard of care, your income taxes, because it's not about what you make, it's about what you keep, the integration of your estate strategies, because if you've got people you love and they love you back, you have shared responsibility. And estate planning is about messaging and navigating the retiree healthcare space. All of that is under one roof, and we're a phone call away. 833-964-PLAN. That's 833-964-PLAN. Or check in with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Craig Bolanos, co-founder, VestGen Wealth Partners. More after this break.
In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So we've been spending our time this morning talking about investing and talking about that theme of 2025, which is one of pragmatic optimism. But with that pragmatic optimism, I think we've got to be realistic when you look out 3 to 5 years on your perspective for the markets. And I think a big part of that is just understanding that the S&P 500 isn't cheap anymore. I know what you're thinking, Craig, tell me something I don't already know. But yes, the S&P 500 is no longer cheap. And there is a big concentration risk in just owning the S&P 500 right now, because you got 10 stocks that make up 34.7% of the entire index. That's big asymmetrical return for years now, but it leads to asymmetrical risk. So that doesn't mean you're selling. It just means you're thinking that now is a time to reduce risk. It's about diversifying your diversifiers, because when you look at that risk reward trade-off for both stocks and bonds, if we're in an environment that is slower growing, it's still growing though. This is what's so good. It's slower growing. We have elevated inflation. I have no doubt the president's going to bring it down, but the absolute level of inflation is higher right now. And we have interest rates that are currently on pause. They're not going lower anytime soon, but I think they can start going lower again at the end of the year if we get a break of inflation. All that means is I think people need to start reducing risk at the margins. And part of that is also rooted in history. And what we've talked about before, and I remind you of, is if you're an investor, you get excited when you have a bull market that gets through its second year anniversary. And guess what? We did that in the fourth quarter of last year, because those bull markets that tend to get through a 2-year period, they tend to be more durable. They tend to last longer, meaning they can go into year 3, 4, 5, 6. But guess what? Year number 3, historically, if history is the only guide, and it's the only guide we got, year number 3 tends to be the weakest of the cycle. So I think it's time that we all have a reflective pause, And with that reflective pause, we use it as an opportunity to say, hey, What do we want our investments to be when we grow up? What do we want our cash flow strategies to be when we want to grow up? If we could start over, what would our portfolios look like to drive the results that we care about, which is, again, nothing more than staying retired? And that means not losing sight of the fact that bonds still have their place. But too many people don't understand bonds. Too many advisors don't understand bonds. Bonds are for those of you who want to stay secure. Bonds are for those of us who want to stay wealthy. There is not one, there is not two. There are 16 sectors of this bond market, and we don't think people should own all 16 sectors. No, you shouldn't. You should be specific in where you're invested and use the tools of the modern day, which are permanence and definition. That's individual bonds and bond funds with guaranteed maturity dates, so you can calculate your yield to worst, yield to maturity, just in case the unthinkable happens. Again, I said I think this president is going to be successful in lowering inflation. But right now, inflation is still stubborn, and we're not yet lowering interest rates. Again, we're on pause. So just in case something happens, if you provide yourself that off ramp by doing bonds the right way, you'll be in good shape. And how good is it that bonds are acting like bonds again? Because, bonds are acting like bonds again. Listen, you might not know, but we spent some time in the upside down world, right? That's a reference to a certain show that was on Netflix. But my comment here is you want bonds that can zig if equities zag. That wasn't the case in 2022 when everything went down at the same time. But now that we have a yield curve that's normal, what do I mean by normal? A normal yield curve is where intermediate term bonds pay more interest than short term bonds. It's a normal yield curve when long term bonds pay more interest than intermediate bonds, which pay more interest than short term bonds. That means we're no longer in the upside down world. Bonds are going to act the way they're supposed to act, and that is fantastic. But you need to make sure you're in the right areas of the market. You need to own the right types of credits so that you're not taking on any risk that you didn't know was in the portfolio. And when you can build high quality bond portfolios today that have yields to maturity still, and maybe this doesn't sound great to people, but if you can build a high quality bond portfolio that yields, I'm going to give you a real number, 5.6%. You want to just park bonds between now and 2032? That basically gets you through the next several presidential elections. I mean, and you just want to get a 5.6% rate of return? There you go. Build a bond portfolio. And how does that work? I mean, if you had $1 million, I'm not saying you should do this, but if you had $1 million and you build a bond portfolio that's yielding 5.6%, that's the yield to worst. That's generating $56,000 a year. Spend the $56,000 a year. You're still going to have $1 million in 2032. That's just one example of, that's not a solution for all of someone's money, but that's the power that bonds can do for somebody right now. And if you're hanging out in high yield money markets and high yield savings accounts, look at the number of high yield money markets and high yield savings accounts that have broken the 4% mark, meaning they're all yielding less than 4. And how many are all going to yield less than 4 in the not distant future as this yield curve continues to steepen, meaning short-term rates come down and the intermediate to long-term space begins to rise. Now, I've talked about it for the last several weeks. I got to mention it again. Our theme of diversifying your diversifiers for 2025. Rebalance from stocks to bonds, please. Make sure you do that in accordance with your risk budget. Number 2 on my list, as you buy those bonds, make sure you do them with permanence and definition. Don't just buy the aggregate bond index. It is bad. Make sure you own the right types of credits. Don't own every flavor of the bond market. And understand what it means to roll up and roll down the yield curve with active management so that you can be doing tax swaps and protecting the yields that you deserve in your portfolio. 833-964-PLAN. That's 833-964-PLAN. Check us out. Get retired, stayretired.com. Rise of private investment strategies. This matters. Everyone is diversified across publicly traded securities, stocks and bonds, but I think there's a reason the world of private strategies makes sense, whether those private strategies are in the form of private debt, whether it's in the form of private real estate, whether it's in the form of private infrastructure, whether it's wrapped up in a shell that is private equity. I think there are pathways for many to be successful, because when you can focus on getting yields in the private debt space, and those yields that are floating rate, primarily first lien, first loan positions, and you can generate historic rates of return of 9%, that's a definite premium to what you can get in the bond market right now. It's a great diversifier, and I think it's something people should learn more about. Number two, I've talked time and time again about real estate, owning secure asset real estate as another opportunity. You don't have to just buy a real estate mutual fund. You don't need to just buy a real estate ETF. You can invest in a private real estate fund that gives you the benefits of depreciation and all of the other components of real estate without having to worry about toilets, light bulbs, and tenants. I think that's a very big deal. Infrastructure goes a long way. Everybody knows we need better infrastructure security. Everybody knows we need better and newer forms of power consumption. Everybody knows we need to make our nation great, unlocking the pipelines, unlocking all of this stuff. And the rest of the world is taking notice. Part of the struggle the rest of the world's going to have with their data centers is the ability to power those data centers with infrastructure, power generation. We've got an inside lane. I think that's a very investable thematic as well in 2025. And if you want to learn more, you absolutely can. 833-964-PLAN. That's 833-964-PLAN. Check us out online. Get retired, stayretired.com. When you're there, download some of our guides, like optimizing Social Security in today's world. That's a useful guide that's available on our website. You should download that. We just had the passage of the Social Security Fairness Act. Entitlements are in the news. Optimize your Social Security in today's world. That's a downloadable guide from our website. Get retired, stayretired.com. All right, here's what we're going to do. We're going to pay a couple bills. That means we're going to do a commercial break, and then we're going to talk more about some sincere and actionable ideas that you can be using to improve the lives of yourself and your loved ones financially. This is Craig Bolanos, In the Know Radio, VestGen Wealth Partners, AM 560. We got the answers.
You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
I love it when you contact us, and something that's a theme is people have said, Craig, you're not spending enough time talking about cryptocurrency. And I think what happened is we teased everybody when all those ETFs launched. Back in the day, we talked about crypto. So I think going forward, I'm going to spend a little more time talking about crypto on the radio. And I think it's important because more broadly, I understand that Bitcoin, I understand that cryptos, they're not appropriate for all clients. But the reality is that today, whether or not you choose to have an allocation to cryptocurrency like Bitcoin or not, you got to know what's going on. You got to understand the administration is supportive. You need to understand what's happening here. So my goal is just to make you aware of what I call the most important news from time to time. And here we go. Number one, I got some milestones. In case you didn't know it, Bitcoin turned 16 years old. Why? The darn thing was created back in January of 2009. So we just had its, 16th birthday. And Bitcoin did hit an all-time high not long ago, surpassing 109,000. But here's where the news gets really interesting. Domestic state adoption. Numerous U.S. state officials contemplated, proposed, or have actually advanced legislation to add Bitcoin as a strategic reserve asset. Who's on that list? New Hampshire, North Dakota, Texas, Oklahoma, Wyoming, Massachusetts, California, Utah, Arizona, yes, even Illinois, South Dakota, Ohio, and Kentucky. I'm not saying they should, but if you've got U.S. state officials saying that they're going to take some of their state's treasury money and start putting it into places like Bitcoin as a strategic reserve, I think we should listen. And it's not just domestic. What about abroad? There's big international adoption. We got to look outside of our borders. I mean, the Czechoslovakian National Bank approved a study on adding Bitcoin to its reserves. Yeah. I mean, I don't know. I wouldn't think that national banks would be doing this, but they are, and they cited diversification of their assets. And then you look at the outlook. This didn't come from me. This one came from a report from Fidelity. And then it's 20-25-year look ahead. Here's what they predicted. Nation states, central banks, sovereign wealth funds, and government treasuries will look to establish strategic positions in Bitcoin. Oh, boom. That's what they said. And I just told you about what's happening domestically. I just told you about the international side. So we might be entering into a new era of digital assets. And it could be one that spans multiple years, if not decades. So I think the time is now that if you're not educated on cryptocurrency, you're not educated on things like Bitcoin, you need to start getting educated. Did you know that there's also some accounting changes? Yeah, you listen to the show because we're nerdy. So here's a notable accounting change. Tesla, the maker, saw a 600 million mark-to-market boost from Bitcoin thanks to new accounting rules for companies that hold crypto, okay? So when there's new accounting rules, it's also going to drive interest, not just from citizens, not just from speculators, not just from, domestic states, international countries, sovereign wealth funds, but you're starting to see, because of the accounting changes, it might end up more on the books of publicly traded securities. And I think all of that creates demand for this thing. It maybe creates demand. It wasn't long ago. It's only been a year, right? This started last February. So we're a year into it now that the exchange traded funds all launched that track the spot price of Bitcoin. And 4 of those spot coin Bitcoin ETFs finished in the top 20 US ETF launches of all time. That's newsworthy. There's even a local company who launched the world's first protected Bitcoin ETF. That's interesting. There's protected Bitcoin ETFs if you want to learn more. So our number, 833-964-PLAN. 833-964-PLAN. Reach out to me through our website, getretiredstayretired.com. That's getretiredstayretired.com, because I think you need to know more about cryptocurrency. I think you need to know more about Bitcoin. I think you need to understand your risk budget, and you might want to consider getting started. And I saved this last piece. What about the policy front? I just talked about the accounting changes. I talked about the fact that there's all this money flow into the ETFs that launched. They're a year old now. I mentioned the international adoption, the domestic state adoption, the milestone of cracking 109,000 earlier this year, 16 years now in development. Well, what about this? The policy front. President Trump signed an executive crypto order, which included creating The Presidential Working Group on Digital Asset Markets. If you wonder if I struggle getting that one out, but there it is. I'm going to say it again. On the policy front, President Trump signed an executive order that included the creation of the Presidential Working Group on Digital Asset Markets, right? And those key goals: strengthening U.S. leadership in digital finance, improving the regulatory environment for digital assets, establishing, here you go, the big news, a digital asset stockpile. So I think you just got to read these headlines and say, you know what, if I've never been involved, maybe I want to find ways to get involved in some small or some meaningful way, but you got to get educated first. That's 833-964-PLAN. 833-964-PLAN. Go to our website, getretiredstayretired.com. Bottom line on all this stuff, Bitcoin, it's seen a volatile start to 2025. By the way, like lots of other assets. But the reality is that the adoption of Bitcoin, cryptocurrencies into investors' portfolios, it's really starting. And it's expanding the regulatory outlook. It's been improved. And I think it reflects fundamental tailwinds that remain so far in place for the new year and beyond. And this could be one of those long-term secular trends. I'm not excited about a digital dollar. I want to continue to have hard currency. But so much of the world is moving digitally. And if we don't want to watch life pass us by in the blink of an instant, then we need to be informed, find ways to participate, find ways to hedge. And we offer a gateway to do that with good, high-quality, regulated products for those who have an interest in diversifying their diversifiers in their portfolio construction. Okay, so why do we exist? At VestGen Wealth Partners, we're a family office for everyone. Because if you're tired of just getting your investment advice here, your insurance advice there, your tax advice over here, your estate advice here, your retiree healthcare here, how refreshing is it when you can work with a multi-discipline team all under one roof who's actively serving you, helping you be an excellent steward of all these different verticals that make up your financial ecosystem? That's what I call the VestGen difference. And I want you to experience that. And if you've listened to me on the radio for more than a decade, just the last 10 days, or just the last 10 minutes, if you found us on this station, AM 560 The Answer, you know what it means. We have some commonality. We already have some alignment, some shared thought and shared visions, and you should work with advisors that share some of your values. I invite you to learn more. We want to understand what's important about money to you and your family, and the way you'll connect with us is going to our website, getretiredstayretired.com. That's getretiredstayretired.com. 833-964-PLAN. Hang tight, more to come. In the Know, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
All right, so if you want to get retired and stay retired, you ultimately are going to need to be thinking about making that turn, making that pivot. And it's a positive pivot. It's one from accumulation to one of generating income. And we talk time and time again about the three pillars of retirement income. Capital matters, capital matters. Once you've made it, once you've secured it, you got to understand that risk budget, because you don't want to blow it. You don't want to be investing improperly and take massive hits on the sprint to or just after retirement. Pillar number two, you got to generate sufficient portfolio income. That's dividends, interest, distribution payments from your portfolio to cover the spend, because if you're living off of the earnings, the corpus is always there. That lets you sleep at night. But part number 3 is you got to find ways to grow that capital balance over time. Yes, you still have to grow the capital balance over time so that you can grow your income over time. Because I know one thing, if the cost of a postage stamp has well more than doubled over the last 20 years, if your property taxes have more than doubled over the last 20 years, guess what? That's going to happen again in the next 20 years. And you might not use a lot of postage stamps, but everyone's got a real estate tax bill, and that's a proxy for life, especially if you're in Illinois. Now, if you're thinking about that income plan, it begins with making an excellent decision relative to things like Social Security. And the whole landscape just changed. If you are a retired educator, retired civil service worker, retired public servant, thank you for keeping us safe. If you have a non-covered pension, the strategies that you were going to use prior to January 5th of 2025, the strategies are different now, because we created the Social Security Fairness Act. It was bipartisan legislation, and there's information that you need to know. We've got the answers. 833-964-PLAN. GetRetiredStayRetired.com. And remember, if you're making Social Security elections and you're married, there's no selfish decisions. No room for selfish decisions, because what you do affects each other. And you got to be in tandem. Number 2, if you're fortunate enough to have a pension, please, let's make sure we make really good elections with the pension. And let's also make sure we don't get caught in the tax trap I see happen every single year, where you retire, you start the pension, or you start Social Security, and guess what you find out? You weren't having enough taxes withheld, if not any taxes withheld. And now you got underestimated tax penalties, liabilities. Let's not even start there. Let us help you create a plan to withhold from the source. Next, if you want to have some additional keep the lights on money, and you're reading the room, and tomorrow's promised to nobody. We've all lost people in our life far too early. But if you think you could live, you know what? In fact, I'll say it differently. If you were educated and it led to a good job and you had good access and funds for healthcare, et cetera, shoot, you could live 5, 10, 15 years, 20 years beyond the average. It happens all the time. And maybe for a portion of the money, you do want to consider supplementing your Social Security, your pension, et cetera, with a private pension in the form of an annuity. Because an annuity is ultimately longevity insurance. It's creating a guaranteed stream of income that you can never outlive. So an annuity might be an important portion of your money, but you got to make sure you don't buy the crap. You don't need to be buying some bonus annuity. You don't need to be buying some long surrender charge annuity. You don't need to be buying some annuity that promises you'll participate in every day of the stock market's meaningful advance without ever experiencing the decline, only to find out that you're locked into a product that's really only making 2, 3, 4% a year. There are ways to structure annuities the right way, the tax efficient, dirt cheap, low cost way. And that's what I want you to learn about. Next, we got to figure out how we're going to do this. And there's all these rules of thumb, right? There's the 4% rule, which has now been renamed by some the 3.1% rule. There's this rule, there's that rule. Here's what I think. There's a really simple, time-tested strategy of buckets of money. And that means when times are good and things look right, you need to make sure that you've got a disciplined approach to have at least 3 years worth of your cash flow invested in stuff that's going to keep its value. Remember earlier in the show, we talked about the bond market. There's 16 flavors of the bond market. There's a reason that someone can be laddering monthly maturity treasuries, monthly maturity agency, monthly maturity this and that to correspond to the exact cash flow that you need. And when times start looking a little bit rocky, what do? You increase those cash flow reserve accounts from having 3 years of safe money to closer to 4 years of safe money to make sure you never, ever have to touch the investments. But because you're going to be living from that cash flow reserve account, you've got to have a mechanism, something that's TNT, tested in the trenches, that's going to allow you to generate dividends, interest payments from that intermediate bucket and the long-term bucket and waterfall it down so you're constantly keeping your cash flow reserve account safe. But my point here is, if you could picture this visual, you're going to have excellent choices on all of your guaranteed sources of income. Some people might want to create additional guaranteed sources of income through an annuity. But then you're going to have to refine a systematic, repeatable process where you have a cash flow reserve bucket invested properly with defined maturities and defined outcomes. That's individual bonds, various other portions. You're then going to supplement that with your intermediate term bucket that's designed to be an equity income machine. Think dividends, private credit, real estate, preferred stock, you name it. And then you're going to have your long-term bucket, which is where your true CAGR, compound annual growth rate, is going to come from by investing in great companies of America, but by doing it in such a way that you have great thought and intention. And within your risk budget, you diversify those diversifiers and consider things like I even mentioned today, like the world of cryptocurrency and Bitcoin for those that want to learn more and want to participate. And listen, we want to connect with you, our listening audience. AM radio is alive and well. So many of us, we just keep it playing in the background. Why? Because we're information junkies. But if you hear this show, you listen to my radio program, I have the heart of a teacher, probably because I come from a long line of professional educators. I just ended up in this role on Wall Street, creating a family office for everyone because I wanted to do a specific type of education, that education being financial education. But we're also in a position to help you implement, because you can't just have IQ. You can't just have intelligent quotient. This is an execution business. The business of getting retired and staying retired. So you need to work with a firm that has both forms of IQ. That's intelligent quotient and implementation quotient. And yeah, I said a firm. You don't want to hire a solo advisor that has an assistant. That's too much reliance upon. You want to hire a dedicated team that has backups and resources, because markets, economies, tax laws, and geopolitics never sleep. And you need to make sure that someone's always there proactively doing things. That's what we offer inside of our multidisciplinary firm under a fiduciary standard, working to always put you, the client's interest first. Connect with us. 833-964-PLAN. That's 833-964-PLAN. Check us out online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. The name says it all. I'm Craig Bolanos, co-founder, VestGen Wealth Partners. You're listening to In the Know Radio, AM 560, The Answer.
Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Hey, everybody. The Great Rotation remains. The Great Rotation is here. I believe it's real. I believe it's got some sustainability, and I think you need to take a look at that in your portfolio. I mentioned in previous radio shows that in January, so as goes January, so goes the year. And what did you find? You saw all these different sectors in January, like healthcare, financials, industrials, energy, having good, positive momentum and results, while some of what's worked the past several years was in last place. February thus far is continuing that trend, and I think it's going to keep happening. So my question to you is, When you're rebalancing your portfolios, that's just not stocks to bonds. Rebalancing is not just multiple market cap, large, mid, and small. Rebalancing is not just about that domestic, international, keep that overweight to domestic, stay invested in the US. It's also about the sector leadership. You need to make sure the individual names you're using, the ETFs you're using, or the funds you're using are going to where the value might be. And the value might be, I'm kind of telling you where it is. It's in this great rotation. I think you can overweight growth, but growth is not just technology. There are so many areas that are growth. Energy will be growth. Healthcare redefined as growth. Less regulation, less bureaucracy. Financials are growth. There are growth engines everywhere. And all of these non-tech sectors, by the way, are also going to benefit from what I talked about earlier in the show, which is productivity, because everyone is adopting AI. It is that transformative. But if it's about earnings per share being powered by productivity per unit labor hour of cost, these are game changers. And I want to make sure that you're broadening your investment horizon because it's consistent with my theme of pragmatic optimism and diversifying your diversifiers in 2025. Why do I use the slogan, get retired, stay retired? Because I've learned in the 25 years of doing this now that that's really what matters. People want to live more, and that requires them to worry less, which means they just have to use strategies that keep them retired so they can sleep at night. And if that's what you want, we want to help provide you that because we have a strong history of accomplishing it. We survived the dot-com bubble. We survived the great financial crisis. We got through COVID, and we'll get through whatever else is next. But do it with a partner. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. This was Craig Bolanos in the know, VestGen Wealth Partners.